The currency continues to weaken as it inches towards that crucial mark of 63 to the US dollar. Of course, there's lots of news which is triggering this. There's talks of the QE taper, which might happen sooner rather than later. And that's, of course, plaguing fears across the globe. 62.85 to the US dollar. The latest minutes from the Fed is clearly what is putting worries on. You've got speculation that perhaps the RBI could intervene in the currency at around 62.9, but that's really failing to prop up the currency as it continues to linger near those one-week lows. The dollar index, mind you, is at over a one-week high, gaining for the second straight day. The government also plans to auction the new 10-year bonds on the 22nd of November, as the 10-year bond yields that continues to remain high, well above the 9% mark also in today's session. And in fact, it's at the highest level in the last 3 months. So since the 20th of August, it was in 9.09%, 9.07% for the bond yields as we speak. And in fact, you've got the call rates, which are ranging between 8.6 to 8.8% today. But all in all, for the equity markets too, the rub-off effect of the currency isn't boding well, and we continue to see that selling pressure absolutely unabated, Neeraj.
Yeah, and that might just continue today, because if you look at the global markets, they may not fare well too. European shares are in all likelihood will open lower after the Fed minutes. So all of that will put pressure on the benchmark indices as well. 1.25%, 2 days in a row, we've had some stiff selling, and the rate sensitives naturally so are facing the brunt. So banks, led by probably the private sector banks as yet in today's session, but 2% or more so down for the bank Nifty doesn't augur really too well. While we will talk about the broader market stocks with our research team members as well, if you look at the list of the Nifty losers, you will see what I'm talking about. Axis, IndusInd, PNB, Bank of Baroda, HDFC, those are the top losers. So momentum as well as rate sensitive stocks in nature are the ones which are bearing the brunt. And there is no respite. There is no stock which is actually putting up a fight on the upside, which is why such kind of pressure really on the benchmark indices. Broader markets too have come off, not as much as the large caps, but yes, there is a bit of a red on the screen, and which is why the market breadth would be in the negative.